Introduction to this assignment is assignment on the study of income tax in Japan. The objective of this assignment is the writing in this section focus on analyze the effect of individual income tax in Japan in terms of effect on the government, economic, and society. And then an annual tax known as income tax is levied against those who receive incomes of revenue kind such as profit from business, profit from employment, dividend, interest or discount, and rate, royalty or premium, pension, annuities or other periodized payment, and profit not included in any of the detail. That's all from me.
Assalamualaikum. My name is Nur Shafika Ilyani binti Zakaria, matric number 279249. I will continue with definition of tax. Individual income is essentially considered to emerge at the area work administration are delivered. Thus, compensation, pay, reward or comparative compensation paid to a worker for administration acted in Japan is by and large to be Japanese obtained pay. Individual income tax in Japan consists of national income tax and local inhabitant tax. Tax treatment is dependent upon individual residency status. There are two classifications of individual taxpayer, which is resident and non-resident. A resident is a person who's living based in Japan or has dwelt in Japan for a caseless time of 1 year or more. A resident is additionally delegated either a non-long-lasting inhabitant or an extremely durable occupant. A non-permanent resident is an occupant who is definitely not a Japanese public and has had a living base or dwell in Japan for a time of over 1 year and 5 years or less over the most recent decade. A non-permanent resident is burdened on the singular pay other than unfamiliar source pay under the Japan Cash Regulation, paying little heed to where it is paid, and their unfamiliar obtained pay paid in or dispatched into Japan. A permanent resident is an occupant who is a Japanese public or has been living in Japan for a time of over 5 years over the most recent decade. An extremely durable occupant is depend upon personal duty on overall pay, paying little heed of source. A non-resident is an individual other than inhabitant. I will continue with tax purpose. Individual income tax in Japan has a general and specific purpose. The general purpose is closely related to the foundation general something of taxation, such as justice and its nature. Among the purpose of individual income tax in Japan is to increase the revenue of the Japanese government. This is said so because through income tax, individuals can indirectly increase revenue to policies that increase economic activity, income, and wealth for the Japanese nation. The most important source of government funding other than service fees, loan, and printing money for the Japanese government is through individual income tax. The economic structure derived from individual income tax revenue is also a major source of income to increase the revenue of Japanese government, which has a very sensitive impact on the entire economic system. Besides, individual income tax is also for boosting Japan's economic growth. Economic growth in Japan is growing rapidly due to system management tax run efficiently and transparently. This tax has also provided a return height to the national economy while driving economic viability in achieve full employment. This is because of the sustainable disposable income and a stable labor market has been the effectiveness of taxation individual income in Japan. In addition, individual income tax in Japan can indirectly bridge the distribution gap between communities. The individual income taxation system in Japan is also able to bridge the widening income gap between the rich and the poor. This is said so because the marginal tax rate, which is the additional tax paid on the highest additional income unit in Japan, the revenue will be able to close income gap and at the same time can distribute to the poor through livelihood assistance, scholarship, and government subsidies. Therefore, with the proceeds of the tax collection can be redistributed to the people to ensure the welfare of society can be achieved and guaranteed.
Good morning, lecturer. My name is Arivalagi Anapurupapi Anandurai. My matric number is 2787828. Today, I would like to elaborate my part, which is type of taxes in Japan. In Japan, permanent resident taxpayers are tested on their worldwide income. Non-resident taxpayers are tested on their Japan source income only. Non-permanent resident taxpayers are tested on their income other than foreign source income, such like in particular or certain or potentially on certain capital gains. Generally, in Japan, the local inhabitants taxes is imposed at a flat overall 10%, and Japanese local government, prefectural and municipal governments levy local inhabitants taxes on taxpayers' period income. A non-resident taxpayer Japan source compensation employment income subject to a flat 20.42% to the national income on gross computation with no deduction available in the Japan. In the Japan, there are 14 types of income tax deductions. One of the deduction is a casual losses, medical expenses, deduction for social insurance premium, deduction for small scale enterprise mutual aid premiums, for life insurance premium, for earthquake insurance premium, for contributions for personal with disability, for the person with disabilities, for widows and the working students, for deduction for sports and deductions for the dependent, deduction for the purpose of studies. That's all from me. Next, I would like to pass to the next presenter. Thank you very much.
Hi and Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Haryani binti Muhammad Azhar, normal metric 278482. So I will continue with the presentation with the income taxation rate in Japan. The taxation system started in 1885 in Japan. The income tax rate was started with as low as 5% until to the maximum was 70% based on the marginal amount of the individual income. So it means the local government will deduct your pure year income. However, in 1987, the tax system has reformed in terms of the rate taxation. As you can see in the table, the changes in income tax rate. For example, in 1919 until 2006, the income rate was started with 5% until 37%. Meanwhile, starting 2007 until 2022, the lowest rate remained the same, which is 5%, but for 18 million yen to 40 million yen, the rate was changed to 40%. For those who their income more than 40 million yen, the tax rate was 45%. For your information, in Japan, a non-resident taxpayer also use the same rate tax as resident, but they don't have any deduction.
My name is Noor Akila binti Azizul, matric number 278850. Next, the principle of taxation. It has two aspects. It is principle of equity and effectiveness in tax administration. The principle of equity refers to fair and equitable taxes imposed by the government. Japanese income tax is the vertical equity. Vertical equity is the tax charge varies according to ability and income. If the income is low, then the tax charge is low, and if the income is high, then the tax charge is high. For example, 1,950,000 yen to 3,300,000 yen is taxed at 10%. Tax income not only applies to residents but also to non-residents. Therefore, the equity principle of Japanese income tax is fair and equitable because the tax imposed is different for each individual. The agency responsible for collecting taxes in Japan is the National Tax Agency. The National Tax Agency has created e-tax as the official tax website of Japan to make it easier for organizations to file tax returns and pay national corporation taxes. A person who does not pay taxes, such as living in Japan, has an annual income in excess of 20 million yen will have from his salary, or the employer will not pay his salary. This is because Japan has the withholding tax system that results in wages not being paid as long as taxes are not paid. The National Tax Agency encouraged increasing state revenue and income. A person who fails to pay taxes may be imprisoned no existing 10 years, a fine no existing of amount of tax evasion or both.
Firstly, tax effect on central government revenue. As we know that the government revenue generated tax revenue. We can say that the tax revenue one of the biggest fund for country to generate their income. The tax revenue include the income tax, consumption tax, property tax, and others. However, this income source still cannot afford the government expenditure. As you can see in the table, we found that Japan also experiencing deficit budget like other countries. In fact, from 1975 until 2021, the national budget continuously was deficit, especially in 2020 because of the pandemic COVID-19. However, the Japanese government revenue always recorded an increasing amount of tax revenue from 2016 until 2020. But unfortunately for 2021, the government revenue has decreased to 106 trillion yen. Even though it decreased, but the Japanese government made an 1 trillion yen for the social security due to the low birth rate and aging population. However, in Japan, the tax rate burden still lower, which is 80.9% than the other countries like Sweden, Germany, and France. So the government always promote the low interest rate environment. So indirectly, they can attract the non-resident to stay in Japan. So it's an opportunity for the Japanese government to collect income rate from the taxpayer.
The effect of taxes on the economic growth of Japan. As we know, Japan is the one of the best country in the economic growth. As we know, until recently, the Japanese economy was growing very quickly. Much of this government's increasing in workers' productivity. Workers also increase, and their productivity towards the economy also increase. The higher productivity was due mainly to increase capital machines and some other things such like a technology, a higher educated and skilled labor force, supportive government policies and a good world trade environment. Despite the many role taxes can play in the growth of Japan's economy, they also can shift the growth by being Japan's economic activities. It's popular for high taxation, multiple taxation, and double taxation. By this high taxation and the double taxations, this Japan government were able to collect a lot of money, and it's also helped to the growth of their economy. High taxes are when the government imposes an unreasonable taxes on corporate profits and multiple. Also, that income tax occurs when the same income tax is taxed multiple times. Double taxation is when they are payers from resident and non-residents. The same taxes twist when moving from the country to another. The sources available to the taxpayers for investment have been reduced this long. From the study, the GPD at purchase prices is the sum of gross value added by all resident producers in the economy, plus any product taxes and minus any subsidies not included in the value of the product. This study also proves that the taxes from the non-resident and residents is help to the growth of economy in Japan as well. That's all from me. Next, I would like to pass to the next presenter. Thank you very much.
Effect of income tax to society. The next is effect and increase in the cost of living of society. The next effect is increase in the cost of living society. Second, motivating effect. Increase income tax lower take-home earning and may lessen the motivation to go work. Either employers choose not to work extra or they quit their job entirely. The last one is the lowering of taxpayer disposable income is a result of taxation. As a result, they will spend less on necessity that must be purchased in order to increase productivity.
My name is Nur Ashila Rinki Azizul, metric number 278850. In conclusion, income tax is important to the country in increasing national income. This could offset the country's economic effect by several factors, such as pandemic of COVID-19 or food crisis. Income tax in Japan affects three aspects. It is government, economy, and society. Japan is one of the countries that imposes high tax. However, this tax helps the country ensure economic and society stability. Traders do not miss out on paying tax, and the taxes imposed do not take into account a person's status. There are communities who feel that taxes imposed are burdening them. However, the tax revenue earned can help reduce the cost of living of the community. Therefore, taxes not only have negative impact but also have positive impact, especially on the country.